Hello, this is the Oak Bloke, and I'm going to be covering Ocean Wilsons, and for those of you that kind of don't know this share, I mean this is a share that has recently done a tender offer at £15.43. They did so because they owned a company called Wilson Sons, or part of Wilson Sons. They originally owned all of it. They floated some of it about 2.5 decades ago, 3 decades ago, and sold the rest of it to a large ports company, which went through this year. So they had a wodge of cash. Some of that cash went as a buyback, and as soon as that had been completed, they then launched a merger with Hansa. So there's two companies, Hansa and Ocean Wilsons, that are merging together. And I suppose it would be fair to say that if we went and looked at, let's just quickly have a quick look at Ocean Wilsons, that it would look to be in a bit of a sorry state for itself, as in you can see here that so the tender price was at £15.50, so it was about here. And you can see that that obviously with arbitrage that sort of held the price at that, and then the tender went through, it dropped a bit, and then since then has dropped a lot. It's dropped now to, I think today's low point was £10.90. And I know that because I bought some at that price. And I guess this video is, why did I buy? Now this this is based upon some, this I did a prior video on this, so I'm not going to repeat everything, other than to say I've obviously recalculated this now based upon, well, in fact it dropped a bit since, so it's now at 11.05. So if you were buying Ocean Wilsons at 11.05, you're buying that at a 43.9% discount to NAV. So you're essentially, based upon the merger, and I won't go through all the logic of the merger, but you've essentially got two classes of Hansa shares here and here, and the prices for those two were closed at those prices. You've got the price for Ocean Wilsons, and then there's the sort of NAV per share post merger that I calculated, where OCN is going to merge at a higher rate than Hansa, and it's all to do with the fact that there's sort of different numbers of assets and things like this. I won't bore you with kind of the specifics there, but obviously once all of this merges together, then what you'll have is a Hansa share. So your OCN shares will become Hansa shares, but you'll essentially get more shares than the Hansa people. The Hansa get 1/3 of a share each for each one of their shares, whereas an OCN person gets 1.49 shares. So the relative prices, I wouldn't get too hung up on that, but it's all to do with thinking about the discount and the discount to the last NAV. Now, the last NAV was as at the 31st of May. Okay, and obviously today, as I record this, it's the 8th of August. So it might be interesting to kind of consider, well, what's happened in June, July, and August. So purpose of this video is to look at, and I'm not going to sort of bore you silly, but let's look at, these are the combined holdings. Okay, combined holdings. Now these top 10, because Ocean Wilsons essentially holds the same shares that Hansa holds, and they're merging it all together. Okay, so that 67 million, for example, what I'm doing is I'm taking the whatever it was of Hansa and whatever it was of Ocean Wilsons, which is over here. Okay, adding them together to get the combined value. So essentially 67.4 million of the NAV, and the NAV is 900 million, okay, as at the 31st of May. So essentially, this alone is kind of, well, you do the maths. I mean, 67 of 900 would be sort of about 7%. 7% of the fund is basically just tracking the S&P 500. Now, I was having a conversation with someone today where I said, well, not being funny, but when you just look at the S&P 500 and, like, well, just sort of, see, have to find a tracker. There we go. That one will do. I mean, obviously, since the end of May, so if we did a 3-month view, something like that, that is the so it was at 4.5, and it's now at 4,875. So the S&P is up by about 7 or 8% since. So 8% or 7% of the fund, okay, is up 7 or 8% in the space of 2 months since the last NAV. And I sort of just started to think to myself, well, hang on a minute, like, well, what about all the others? So what I did was I just started working through these. So Findlay Park is the next one up on screen. So Findlay Park, this one here, is up. Okay, so again, it's up a good couple of percent. So if we say, let's take the from the end of May, which I guess is there, it's up what, a couple of percent, 2%. So that's up. Okay. The next one along was so the next one along was this BlackRock Strategic Fund. And it took me a while to find this actually, but earnings projected earnings growth 8.9, historical growth 8.7. These are the top holdings, and essentially these look to be TIPS would be sort of a type of bond. Obviously, that's probably a money market fund, and so on. So you can kind of see that this is a bit of a well, it does say down here. I mean, it's strange that it says it's got that many assets in what it looks to be just bonds, and then it says cyclical. You'd imagine the defensive would be more than 15% if that many percent is bonds. But anyway, not sure about that. That's their reporting, not mine. But yeah, you get the idea that the portfolio and the performance. I mean, you can kind of see here. Again, they show, I think, yeah, trailing returns 3 months. This is delivered 5.8% in 3 months. So again, a nice decent return. I thought, okay, well, what about the next one? So the next one was this, which is this is a hedge fund, Select Equity Group Partners Long Short Equity Fund. So it's sort of, they'll short stocks, they'll go long on stocks. They've got, well, they sort of say it here, they've got a big wodge of people. They track 7 billion of assets. This isn't the sort of thing where you rock up and buy this yourself. Like you'd have to have big bucks to kind of open an account with these guys, I guess you could say. Anyway, they lost money in April, but in May they made 4% in a month. In June they made 4.2 in a month. So again, some pretty interesting results. Obviously, that's only over a couple of months, but again, some interesting results. So that sort of takes us. Let's go back to our list. That sort of takes us down. So that was that one. So I mean, that thus far we're down to what, 160 million if I add all of those four together. 160 million. So 160 million of 900 million. I mean, we're almost at 20% of that fund has done well. Let's carry on. BA Butyl Goodman comes next. So let's move him across and over to BA Butyl. Again, past couple of months it's up. Obviously, with thingamajig with Trump, this kind of suffered. It's probably fair to say suffered quite a lot, actually, dropped quite a lot. But yeah, if you look at it over 5 years, I mean, it's not spectacular, but it is positive. and this BA Butyl Goodman US value kind of has Microsoft, has kind of a couple of different. You can see it here. Achieved 13% in a year, 3% in a year, 12% in a year, and the final past 12 months it's down 4%. But over sort of that 4-year period, I mean it's it's growing itself by about 8%, something like that. So yields 1.4, and I think it's sort of software, pharmaceuticals, technology. So majority US and so on. So again, not a terrible place to have your money. The next one is actually one of my Oak Bloke 25 for 25, which is Pershing Square Holdings. And I will be writing an article about Pershing Square Holdings, so I'm not going to say too much other than it's up this year, it's doing well. This is my article, my original article actually, where I just covered off the different holdings, and if you want to read through that, you'll see the potential. I also wrote an article called Fannie Mae Freddie Mac, this one here. And if this comes to pass, so coming to pass would mean this coming out of conservatorship, Fannie Mae and Freddie Mac coming out of conservatorship. Now, what that means in plain English is imagine there was sort of almost like a public sector body that backed mortgages in the UK, and then sort of that became privatized. That's essentially what coming out of conservatorship means. So the upside would be about a one-off boost of about 33% to Pershing Square Holdings if that comes off. And there's a lot of reasons why it will and should. Trump is in favor of it. What it would mean is that it would mean that there's a massive amount of US government debt that would be off the books, because the person that would owe the money or be liable for the debt would be private investors, not the government, not the federal government. Basically, the argument that Bill Ackman makes is, well, the government poured in 191 billion post Great Financial Crash, and since then the government has had more than 191 back. It's had 300 billion back. It's made a massive whacking profit. So you can't feel a bit too sort of unhappy about that. And actually, if you compare it to anything else, is General Motors a nationalized firm? No. Is Chrysler? No. Wells Fargo? No. JP Morgan? No. You can read them for yourself. But basically, all of these had help from the government just the same, and none of these are in conservatorship. So why should these be in conservatorship? And the reason that these ended up in trouble was because they were lending to the subprime people. There was a decision made that should be allowed. Essentially, the argument is just don't allow that. Don't allow crap loans. Just allow good quality loans, and then you don't have a problem. And that's sort of, so essentially what I've done is I've sort of, this article covers the idea of Fannie Mae Freddie Mac and the upside, and the upside would be substantial. That's kind of Pershing Square Holdings. So that's one of the Ocean Wilsons and Hansa holdings as well, is the point. So between the two companies, there's actually 18 million, so about 2% of the fund. We then move to global insurance, Polar Capital. So let's move on to that. Polar Capital, well, you kind of get the idea now that, that's up. Up 8.5. You can see there it was sort of double-digit gains for every one of the past 5 years, 15, 15, 11, nearly 20, only 8.6 so far in the last 12 months, only 8.6, and down 1.3 today. So positive once again. And you can see, like, since May, has it kind of gone up? No, not really. So if you take sort of, from the end of May, which would be there, to be fair, that one's down about 3 or 4%. So, okay, 3 or 4% down. Next one, global technology. This one's up an astonishing 45% over the past year. And again, if we have a look at sort of the last couple of months, whoosh, whoosh. So, there's what's that? That's the end of May there, up massively, up massively. So, and then Asian total return up 12.6, and finally expanded tech software, again it's up. That's today's so if I just change that, it's up. Okay, so all very positive. As far as I'm concerned, I cannot see a reason for this to be at a 46% discount, sorry, 43% discount. I think it's slightly higher because of today's drop in price, but the 43.9. I think with these price, with the change in the NAV post period, you're looking at something closer to 50%. And why should you? Why would you? Why would these be worth half of what they're worth? There's no sense to it to me. I think that gap will close, and there's a good opportunity at Ocean Wilson. So anyway, that was enough from me. That kind of was the gist of this article. So it's only a brief 16-minute view, which is pretty fast for me. So I hope that's been useful. Hope that gives you some ideas. And as these are the discounts on Hansa, which is obviously lower now than Ocean Wilsons. So Ocean Wilsons has sold off, I think, to the point of silliness. Is my opinion. Anyway, not advice. It's just my opinion. Hope that's been useful. Cheerio from the Oak Bloke. Cheerio for now. Cheerio.